Hello, everyone, and welcome back to another installment of our Lunch and Learn webinar series. My name is Mayur Thaker. I am the Senior Relationship Manager here at Zacks Professional Services, and I'll be leading our call here today. And the reason for this call is, especially because of the times that we're living in now, with the rise of these SPACs that we constantly hear about throughout financial media, um, and what that might entail as far as how to think about these types of companies, because the vast majority of these companies that have recently went public are unprofitable. And so the purpose of today's webinar is to understand, although there are many companies that are unprofitable, including the majority of these companies going public via the SPAC route, the special purpose acquisition company. The goal of the webinar here today is to present a framework through which you can think through these types of companies. And just because a company is unprofitable today is not necessarily a bad thing, and does not, in my view, disqualify it from being an investment candidate. Only if it satisfies, in my view, the following criteria that we're gonna walk through here today. So the first criteria, which is the most obvious one, is the step one is revenue growth. So obviously we want to make sure that the companies that we're looking at actually have revenue growth, because many companies, or at least a few companies that have gone public through the SPAC route, and even others, are currently pre-revenue. So that means that these companies have no revenues. They only have products that are still not yet, have not yet come to market. So that would be taking a lot of risk, and especially given where valuations for some of these pre-revenue companies are today, you're already paying for companies that have ramped up revenues even before it happens. So for those companies, I think that would be an immediate disqualification. But step one is to look for revenue growth. So this fits the bill for many companies that are unprofitable today, but have very promising futures because of what revenue growth signifies. And revenue growth basically signifies that the company's products are in demand. So when the company's products are in demand, when there's increasing market adoption, that is essentially a vote of confidence by the marketplace, not necessarily by investors, but by customers, that the company is indeed adding value, either in quality, in the way things are done, in providing a more efficient way of doing things, or on cost, doing something cheaper without sacrificing too much of the quality in order to do it. So revenue growth is by far the most important characteristics that you want to look at for a company that might be unprofitable today. However, that's not enough. Revenue growth is the most important part, but it's not the only part. So step number two of what I would look for in unprofitable companies is evidence of operating leverage. And this is a little bit harder to understand, but it's not, I'll show you in a second here how you can use advisor tools to be able to quickly identify whether there's operating leverage or not. So what is operating leverage? In a nutshell, if there's companies that are unprofitable because even though they have revenue growth, they have made investments that run as very high fixed costs, such that they're unprofitable today. But if they were to continue scaling that revenue, then since a large component of their expenses are fixed, expenses will not rise as quickly as revenues will. So in other words, the revenue growth rate, as I have listed here, the revenue growth rate should actually be eclipsed by the growth rate of any profit item below it on the income statement. So what that means is we want to see evidence of operating leverage by seeing gross profit growing faster than revenue, Ebitda growing faster than revenue, EBIT growing faster than revenue, or non-GAAP adjusted net income growing faster than revenue. Any one of these, if any one of these are growing faster than revenue, then that is an indication or evidence that there is operating leverage. And which one of these satisfies that criteria depends on the company. Some companies are very, very early stage. And so in that case, if it's a very early stage company, then you want to see gross profit be the one. And it's most likely that gross profit will be the one that outpaces revenue growth. If they're further along, maybe Ebitda might be the one that outpaces revenue growth. And if they're really further along, EBIT will be the one that outpaces revenue growth. And similarly to EBIT, it would be non-GAAP adjusted net income. And we'll talk about a little bit about what all that means, but essentially this number right here, non-GAAP adjusted net income, is basically the net income with a few adjustments to it, which adds back things like stock-based compensation or some non-reoccurring one-time extraordinary items. So although the companies may be unprofitable on a GAAP basis, which is the foundation of what, for example, the S&P indexes look for when getting included in the S&P 500 or 400 or 600. So even if the companies are unprofitable on a GAAP basis, as long as there is evidence that one of these metrics here is growing faster than revenue growth, that is evidence that the company can one day become profitable if they continue to scale that revenue growth. So again, the fundamental question is the business scalable? And what that means is, are they unprofitable simply because they have large fixed costs? Or are they unprofitable for some other reason, such as very high variable costs? So if that's the case, then it's much harder to achieve profitability. But if they're unprofitable simply because they made a lot of investments up front in order to realize that revenue growth later on, then that is evidence of operating leverage, and you should see evidence of that by one of these items growing faster than revenue growth. So step one is you want to see revenue growth because that tells you whether or not the company is adding value and whether the marketplace is placing a vote of confidence in the quality or cost of the company's products and services. And step two is one of these items that are below it on the income statement should be growing faster than revenue growth. So in other words, you want to see margins improving, gross margins, EBITDA margins, EBIT margins, or non-GAAP net margins. And then the third item that I would look for, and this is perhaps one of the most overlooked. Everybody talks about earnings, everyone talks about revenue growth, but very few people understand or ever discuss returns on capital, otherwise known as return on assets. And what this tells you is it tells you whether the company is deploying capital to earn high rates of return. And the traditional calculation is net income over total assets. But since we're talking about unprofitable companies, that net income is going to be negative, right? And so the ROA is going to be negative. But we can modify this number for very early stage high growth companies, such as asset turnover, which instead of looking at net income over assets, it looks at revenues or sales over total assets. Another way you can think about it is looking at gross profit over total assets. EBITDA over total assets, EBIT over total assets, or non-GAAP adjusted net income over total assets. And I know this is getting into the weeds a little bit of financial statements, but I'll show you how to kind of do this and simplify this within Advisor Tools, as well as within our Advisor Tools screener, that you can build in these types of criteria to find stocks that match this particular criteria. So in other words, the idea here is we want to identify whether a company is compounding total capital at a higher rate than what investors can earn themselves otherwise. This is the key to picking long-term winners. So essentially, we want to see evidence of asset turnover increasing over time, or gross profit over total assets increasing over time, or EBITDA over total assets increasing over time. Essentially, we want to see the rate of change of any of these items increasing over time. So step one is revenue growth, which tells you what the raw demand is for the company's products. Step two is, evidence of operating leverage increasing. And then step three is evidence of returns on assets increasing. So this tells you efficiency. So the idea behind this, again, to put it even in simpler terms, let's say you have two companies and both are doubling revenue year over year, which is great, right? And holding everything else steady. Let's say one company requires twice as much capital to achieve that 100% revenue growth. Which one is the better investment? And to put it in simple terms, let's say both companies have revenues of $100 million today, and both companies are doubling revenue for each year for the foreseeable future. So they both have $100 million of revenue. They both are doubling revenues year over year, but one company requires $200 million of investments to achieve that doubling of revenue growth. And the other company requires $100 million of investments to achieve that same growth. Which one is better? It's obviously the one that requires less investments that's better, all else held equal, because it requires less, capital invested by the company to achieve that growth. So growth is great, but if it comes at high costs, then that's not as good. So we want to see evidence of increasing returns on assets in this case. So let's take all of this and take a look at a couple of case studies. So we have a couple of cases here that we'll just take a quick look at using Advisor Tools. The first one is Amazon, which is the most prolific example, because despite the fact that they are the beast that they are today, they were at one point and for a long period of time unprofitable on a GAAP basis. The same thing goes with Tesla. Tesla went public in 2010, and they have shown GAAP losses every year until now. Uber has also done a similar thing. They don't have as much operating history, but they have shown net losses since inception as well. And then we'll take a look at Snowflake, which is the most recent, or one of the most recent companies that have gone public, and they are also unprofitable. But let's see how each one of these look like in terms of the three-step framework that I just presented here today. So let's dive right into Advisor Tools to take a look at that. So I have Advisor Tools here open, and what I'm going to do here is I'm just going to go straight to the charting section, and I'm going to go to the fundamental chart. And so that's what this is right here, our fundamental chart tool. And I have it started off as on a blank slate. So what I'll do is go ahead and add the securities that we're going to take a look at here today. So Amazon is number one, Tesla at number two, Uber at number three, and Snowflake at number four. And you can see one of the advantages of Advisor Tools is the quickness and ease of use of just being able to quickly toss in any number of companies. And for those four companies, we're going to take a look at step one, which is revenue growth, right? So we looked at revenue growth as our first step in our three-step, framework. So I'm going to go to, I just clicked under financial metrics. I clicked on browse, and this will give us the full menu of options that we can select from. And I'm going to select that revenue TTM here. And that's going to be our first, item that we select. And let me just uncheck these other three, and we're going to start with just Amazon here. And you can see that Amazon, throughout its history, since 1997, you can see the phenomenal revenue growth that the company has gone through. And this is on a log scale, so you can see that they've achieved a doubling of revenue quicker and quicker and quicker. So this is, the textbook definition of an exponentially growing company. So what does this tell you? Just looking at a pure revenue chart, what this tells you just right off the bat is the company is doing something, that the marketplace just absolutely loves. They are doing something where, customers have clearly found value in year in and year out, even through these shaded regions, which are recessions. You can see that even through the great financial crisis of 2008, Amazon continued to grow revenue throughout all of these different periods here. And you can, over a 20-year period, we've gone through multiple different interest rate environments, multiple different external shocks, multiple recessions, and multiple different other circumstances. But you can see that Amazon has just continued to grow revenue at the top line. However, a lot of people focus on profitability because they look at PE ratios. So let's look at earnings. So if I were to type in EPS here to search for that, let's look at the EPS gap. And look at what that shows us. You can see that despite revenue growth and, exponential revenue growth at that, you can see that at the same time, Amazon was actually increasingly losing money. And throughout this history here, they lost money and continue to lose money, up through 2003. You can see that right there, they posted an earnings loss of 9 cents, and they finally achieved a razor thin profit in Q4 of 2003. And then from there on out, they continued to grow earnings, but it was still a very, very small number. And it was flat at that. Really hasn't done much. It did not achieve much earnings growth at all. And in fact, starting in 2010, you can see here that they started to dip back negative. So even as recently as 2015, almost 20 years into the Amazon growth story, they were losing money on an earnings per share GAAP basis. So anybody focused on earnings per share, either thought that the company was going bankrupt because they continued to lose money, even 20 years into the company's operating history, or they were radically overvalued. And let's overlay price on top of this to see what the price is doing. Because one would think that, okay, if they're dipping in earnings, you would think that the company's stock price would be suffering. And you can see here that it absolutely didn't, right? We saw a great rise, during the dot-com era, and we saw that, really drop during the dot-com bust. But, even during the second round of, unprofitability, you can see here that Amazon stock price, really didn't do much at all. In fact, it continued to grow. So this clearly means that investors are not really looking at earnings here. They're looking at something else. So what might they be looking at? So it's our job to understand, what is it that, investors are focused on, because clearly it's not earnings per share. So if I were to go in here and search for other items, maybe it's Ebitda. Let's check that. So maybe it's Ebitda, and you can see here that it was a little bit of a bumpy ride in the early ongoing time period, but then since then, EBITDA was positive and growing. So this is at least a little bit of a better number than earnings per share on a GAAP basis. So you can see that although GAAP went down, EBITDA continued to grow through that period. So what this is telling you is that, Amazon was investing so heavily in their business that it was distorting the earnings number. But if we were to adjust that earnings number back for some of that investment, which is what Ebitda does, then you can see that it smooths out the number, and this is what the underlying profitability of Amazon really is. So during that high investment growth period, earnings were really bad, but Ebitda was really, really good. We could probably do the same thing by looking at, say, cash flow. Cash flow is the other item that, I think is really, really important to look at. And you can see the same thing. And I'm just going to uncheck some of these here so that way there isn't too much that's distorting our chart here. And you can see that same thing. Cash flow growth has been phenomenal. And you can see during that unprofitable period, cash flow was actually telling you a completely different story. So they were unprofitable on a cash flow perspective in the early going, but that flipped positive and it never looked back, even through this period of unprofitability in the early 2010s. So this is what we want to see. We want to see cash flow growing, or one of these items growing faster than revenue growth. And then the other part of it too, which is step number 3, is looking at the return on assets or return on capital. So if I were to browse again and go into return on capital, here are the various different return on capital items. So it could be return on assets that we look at, but keep in mind return on assets utilizes net income in the numerator, and net income, as we know, for Amazon was negative. However, here is the more important point to look at. Even though the number is negative, you can see that the number is improving over time until it reaches a very, very high point at which it plateaus. But the key idea here is that during that early growth stage, when all the numbers were negative for Amazon, the key point here is that they were achieving phenomenal revenue growth and increasing returns on assets. Even though the number itself is negative, the rate of change was increasing. So that tells you that there is evidence of not only operating leverage, but improving returns on capital, improving returns on assets. And even today, you can see that the number is still 5.83%. That's good, but it's not going to rock anyone's socks off, right? So even today, this is suggesting to me that, despite this low-ish, despite the fact that they've now ramped up earnings, the return on assets is really not that impressive. But if we switch this to another metric, so again, we have to look at multiple different numbers and really understand which one it is that is most relevant for the company. We look at free cash flow return on investment. This is just one of many in here, but I would look at each one of these and just look at whether at least one of them is showing something that's quite different from the others. So if I were to select this one and add it to our chart here, look at the difference here. If we look at free cash flow return on investment, this number is over 35%. So this is looking at free cash flow rather than net income relative to total investments, which takes a look at total debt plus total equity, which is very similar to total assets. It's not quite total assets, but it still captures the total capital structure of the company. And looking at that relative to free cash flow, you can see that number is a staggering 35%. And it was growing during that early period, when the company was still showing earnings losses. So this is exactly what you want to see here. Phenomenal revenue growth, but even better, EBITDA growth or cash flow growth. and improving returns on assets or return on free cash flow or any number of these other metrics that we have. But you want to see at least one of these criteria per category being satisfied. Okay, so that's a great example of Amazon, which showed tremendous losses early on, but that was because of the fact that they were investing so heavily in growth that it was temporarily showing earnings losses even as recently as 2015. But for an astute investor that was looking at something beyond just earnings, you would have seen that adjusted for that investment, cash flow and Ebitda were doing much, much better than earnings per share. So that tells you that if we were to adjust out that investment that the company's making in their own business, the true underlying profitability has never been stronger. And you can see that through this chart right here, where earnings were going down, but cash flow was continuing to rise. The same exact story has played out for Tesla. So I'm going to uncheck Amazon, and we're going to take a look at Tesla here really quickly. We see the same exact thing where we see exponential revenue growth for Tesla. And I'm just going to uncheck some of these here so we can see this a little bit more clearly. You can see, phenomenal revenue growth, especially starting in 2013. And that's continued through today. But if you were to look at earnings on a GAAP basis, look at this. It's been negative and, in fact, going down. It's been negative, flat, and then going down, as of 2018. And only now have they shown a GAAP profit. However, if you waited till now, you would have missed out on the phenomenal run that the stock has been on. However, if we were focused on Ebitda, for example, you would have seen that, this is telling you a much different story. And although they had a brief period of a big drop, in 2018, you could see that this number, was rising despite earnings going down. So it's a very similar story as to Amazon, because, earnings on a GAAP basis penalizes the company for making investments in their own business, in setting up the infrastructure, in setting up the CapEx, and setting up all the charging stations and the factories, to build the electric vehicles that they're doing. So again, if we were to focus on other items besides GAAP earnings per share, it would be telling you a slightly different story. And then, step number 3 is your returns on assets. How is that doing? And you can see that, again, although the number is negative, it was showing a positive rate of change. And you can see that here as well, a positive rate of change. So again, these are the different factors that you want to see here. Revenue growth, Ebitda growth faster than revenue growth, and increasing rate of change on either returns on assets, free cash flow, return on investment, return on capital, return on equity, any of those items there. And we see the same thing for Uber. Now, Uber is a little bit less in terms of its operating history, but we can see on a similar basis what they're doing. And revenue growth here, I'm just going to uncheck this log scale. You can see how revenue growth has grown tremendously since going public. However, earnings have been less than stellar, and on a GAAP basis, they've shown nothing but losses. However, you can see that that number year over year has improved. So they have trimmed that loss since the point that they started when they went public. So, Ebitda, is doing a little bit better. Again, still in a negative, point of view, but still, trimming that loss here. And return on assets have also shown a positive rate of change. So again, this is exactly what you want to see. The numbers are still very negative, so there's still a lot to be proven for Uber. However, based on the revenue growth And if they can continue this, you can see that they're getting hit hard here due to the COVID disruption, with less people, taking rides in ride sharing. I would wait to see if this number rebounds in Q3 and Q4, but we do see a little evidence of the general three-step framework, where we see a trimming of that loss. We see Ebitda growth, outpacing revenue growth. And we see the rate of change of the return on assets improving over time. So the ingredients of Uber one day becoming profitable are all there. As long as these trends continue, Uber looks pretty good to me. So this is the bear framework that you really want to see to be able to identify potential winners who are showing losses today, with the hope that they could one day show a profit, and show a very, very good profit at that. And lastly, our last example here is Snowflake. Snowflake just went public very, very recently, I believe in the past month or so. And instead of using this in Advisor Tools, I'm just going to show you the S1 filing that they put out. And this goes to kind of show some of the consultative benefits of Advisor Tools, where we hold these webinars to not only give you a not only to throw this at you and to say hey, good luck with this, but also to walk you through what we can do here on a consultative basis in giving you some of our own commentary as far as macroeconomic outlook is concerned, as far as the macro strategy is concerned, as well as individual company commentary. So I'm going to talk a little bit about Snowflake using our three-step approach to evaluating unprofitable companies. So step number one, do they have revenue growth? So here in the S1 filing, it's a really nicely put together presentation. Do they have revenue growth? Well, you can see here from their slides, 121% revenue growth in Q2. However, is that sustainable? Well, you can see right here in their revenue growth chart, they've shown consistent revenue growth, since Q3 of 2019. Very, very strong evidence of revenue growth, 121% year-over-year growth. So very, very strong overall growth. Step number two, is there evidence of operating leverage? Okay, so that goes into some of the financials. So I'm just going to click on the financial statements here. So remember, going back to our slides, is there evidence of operating leverage? So we want to see evidence that gross profit or Ebitda or EBIT or adjusted net income is growing faster than that revenue growth, which is already in and of itself growing very, very fast. So going back to this here, we see revenue growth, really accelerating here, where we see, it growing from, about 96 million in 2019 to a staggering 264 million in 2020. So that's, more than 2.5 times revenue growth in just 1 year. So that's phenomenal revenue growth. However, is there evidence of operating leverage? Do they have high fixed costs? And is that the reason why they're showing a loss? Because if you go down here at the very bottom, you can see that their net loss is 178 million last year. And despite the fact that they grew 2.5 times, they actually increased their loss by almost the same amount. Now you see that they lost even more money despite growing the top line by 2.5 times. So that looks like a really negative trend. However, again, the reason why a lot of these companies are unprofitable is because the investments, the spending comes up front. It always happens in that order. Investments in their own company, such as marketing, such as building the infrastructure, such as investing in R&D, such as investing in hiring. All of that are expenses that hit the P&L first before that revenue growth can be realized. So we see revenue growth there that tells you increasing market adoption of the company's products, but the net loss has grown. However, is there a silver lining into this? Let's take a look at gross profit growth. It was at 44 million in 2019, and look at the acceleration of that. It's now 148 million in 2020. So that is a growth that exceeds the growth rate of revenue. Revenue grew at about 2.5 times, whereas gross profit more than tripled year over year. So again, that tells you that because gross profit grew faster than revenue growth, it tells you that there is a large component of fixed costs within their cost structure, and a lot of that is being absorbed by that revenue growth. It's just that because they invested in sales and marketing and research and development, that we see that the loss grew year over year. But that is a really good trend. That is something that I would like to see personally for companies that are losing money today, because that there is evidence of operating leverage. You know, gross profit growing faster than revenue growth is evidence of that. And then last step is there evidence of increasing returns on capital? So remember, what were the different ways we can think about return on, assets? It could be asset turnover. It could be gross profit to total assets. It could be Ebitda to total assets. Any one of these, criteria should be met. Not all of them have to be met. Just one of them is sufficient to give you evidence that there is an increasing level of efficiency of the company. So you want to see growth, but you also want to see increasing efficiencies in that growth. Well, let's take a look at that. Assets, if I scroll down a little bit to the balance sheet, you can see that assets grew from about 764 million to about 1 million in 2020. So that represents only about a 30% growth in assets. So keep in mind, revenue grew at 2.5 times year over year, whereas assets only grew by about 30%. That's really, really good to see. So asset turnover increased year over year. And if you go down even further, gross profit over total assets grew even better because gross profit tripled, whereas total assets went up only about 30%. So again, this satisfies the first two criteria here: asset turnover increasing and gross profit increasing relative to total assets. So that tells you that there's evidence of increasing efficiency, increasing returns on assets, increasing returns on capital. So although the company is unprofitable today, I would argue that there is evidence here that they could one day achieve profitability and achieve very high efficiency profitability at that. And that is the sort of the trifecta, the triple play that you want to see happen in order to spot, winners early on. Now, we didn't talk much about valuation, so that's also a major component as to what your potential returns might be on your investment in an unprofitable company, but that's a different discussion for a different day. However, this is sort of more of an emphasis on underlying business performance. Is there revenue growth? Is there increasing market adoption of the company's products? Step number 2 is, are they unprofitable simply because they're investing heavily in their own company? And thirdly, is there evidence of increasing efficiency? Despite the fact that they're increasing investments, is there evidence that they're earning a good return on that investment? So if all 3 of these criteria are met, then there is very, very good evidence that it will be not only a company that becomes profitable at one point, but it will be a company that achieves a very high return on capital. That is what you want to see to identify or to separate the winners from the losers. So hopefully you found this presentation here helpful. Again, you know, I'd be happy to field any questions you have. Feel free to reach out to us directly at zat@zacks.com. That's zat@zacks.com. With any questions, I'd be happy to help answer any questions you have, or if you have any specific stocks in mind that you want to quickly run through. I should also mention, I do have a screen that's pre-built that helps you find these types of stocks, that help you find this type of, you know, triple cannon, if you will, the trifecta of revenue growth, as well as increasing operating leverage and increasing returns on capital. And the results are very, very interesting. So if you want access to the screen that I built, again, feel free to reach out to us at zat@zacks.com, and I'd be happy to send you the screener, which can help you identify a list of companies that, you know, satisfy all three criteria that I just mentioned here today. All right, with that, hopefully, again, you found this helpful, and looking forward to hearing from you on the next webinar. And I am seeing a couple of questions here. I just want to get through those really quickly. Yes, I will give you a copy of this presentation deck. If you do want a copy of this deck, again, please reach out to us at zat@zacks.com, and I'd be happy to send you to that. Another question is, how do we find adjusted EBITDA? So right now we have just Ebitda. We don't have adjusted Ebitda in Advisor Tools. That is something that we're working on in providing. However, you can calculate out adjusted Ebitda by using the tools within the screener, as well as if you have access to the Excel link, then you can also a custom calculation to come up with adjusted Ebitda. So if you want to walk through that, I can also send you a raw spreadsheet that has that already pre-built out for you. And lastly, is it possible to have a recording sent to our email to review further? Yes, this presentation was recorded, so we will be uploading this to our YouTube channel shortly, so we will send that out as well. So again, if you have any questions, please, again, feel free to reach out to us at zat@zacks.com. Hopefully you found this helpful, and looking forward to hearing or, you know, seeing you again join our next Lunch and Learn webinar. All right, take care, everyone.